Hi, I'm Scott Houston, your host of the Local Officials Stronger Together podcast series. We're about to embark on a new adventure. We're going to be doing short videos explaining different facets of how the pool operates. The first one we'll do will be a series called the STP Special Report on Rerates, and we'll be talking about the drivers of rates for the upcoming season. Please join us as we learn about this important topic.
This episode is part of the pool's Local Officials Stronger Together podcast series. It's one way we serve local officials through integrity, public service, fiscal responsibility, and operational excellence. As always, please direct specific questions about coverage to your member services manager.
All right, welcome back. I'm here with Tito Villegas, and Tito is the pool's money man. Tito, tell us a little bit about what your position is, what you do in your position, and how you came to be at the pool.
Well, thank you, Scott. I've been with the pool for 31 years, and I'm the CFO, Chief Financial Officer, and Chief Investment Officer, and it's been a pleasure. Every day is fun to come to work. Right now, we're looking at what we're doing with rates next year, what we're doing with our budget and working on budget. But I do want to start out, Scott, by talking about why the pool was formed to begin with.
Yeah, please.
Back in the 70s, basically municipalities and cities could not get insurance coverage. The commercial providers were ignoring them, the profits weren't there for them. Can you imagine the little small cities that we cover today, what they had to go through back then? And it's pretty relevant as we face the issues today with the presumption, workers' comp presumption cases, where we've seen providers back off again from municipalities. So that's why the risk pool was formed. TML took an initiative back in the 70s, grouping a small group of cities to form the risk pool to fill that void, Scott.
Right, and so the finances are obviously the big deal, right? That's number one. Tell us a little bit about how the Texas pool is structured financially.
That's a good question. The way it works is we meet with our members, our underwriting department, our loss prevention reps, meet with our members to assess risk. Remember, the reason that a city joins the pool is for risk management. They have to look at the risk just like we do at home. When you have a home, you want to buy insurance. When you're driving a car, you want to protect that property and your family. Cities have to do the same thing by assessing their risk management. Scott, larger cities have their own resources to do that, but the smaller cities come to the pool for that. We look at their risk, we find out what their contributions should be for next year, and we ask the members to go ahead and make that contribution to cover those losses. That's our structure. What happens, though, is after a good year, which our revenues are higher than our expenses, it builds members' equity. And cities can think of that as fund balance. It's our safety net. It's our savings account for those tough years. And we've had a couple of tough years, as you know, Scott, the last couple of years. So once we build that members' equity, we go out and we say, well, how much members' equity do we need? We do a risk assessment at the pool, Scott. We actually have an actuary come in and say, what are the risks that the pool faces? And one of the largest risks that the pool faces is what they call underwriting risks, that occurrences occur that happen that we weren't anticipating. And we've had two of them, Scott. We've had the COVID pandemic, which is a one-in-a-lifetime event, and then we had a Texas winter storm. There's no way anyone would have anticipated those occurrences. So now we use our members' equity, our safety net, to take care of those losses.
And the board has actually adopted a policy as to how that reserve works, right? There's a range of income that we need to maintain that reserve or member equity balance.
Exactly. A key question, and we've returned a lot of equity to members over the years, but a key question is how much equity do we need to maintain to support this program? So we have an actuary look at our risk, and they set a minimum. And that minimum is an occurrence that occurs in 1 in 200 years. So in other words, it's a very low probability, but it can happen. And that minimum is about $311 million of members' equity we need to maintain. Then we look at the upper part of the range, which is 2 times that limit, which is $611 million. That's really important, Scott, because 2 years ago, we were around $400 million on our members' equity. But last year, with COVID and with the winter storm, the pool actually used that equity, about $40 million of that equity. Now we are at the lower part of the range.
And so there's actually sort of a pooling standard, if you will, that's kind of based upon the risk aversion or the level of risk that the board of directors is willing to accept, and that plays into that policy as well, right?
Exactly, and the board determines the risk tolerance, and that's where they came up with those limits. One thing that we have to be aware of is that we try to set our contributions to cover losses, and that's what we're doing right now. That's what we're in the process of relaying to our members. In fact, the board considered our rates in April, looking at what factors are impacting the losses going forward. There are two main factors, and that's loss experience. When you just like when you have an automobile accident at home, your rates are going to go up. So loss experience is one. The other that we're facing right now, that all of us are facing, is inflation, and that's mainly in our property fund. You asked earlier about our structure. We have separate funds for property, workers' comp, and liability. And so right now, the inflation factor is really impacting our property rates, Scott.
Right. So the pool is a unit of local government. We have court opinions that say that we are. And that means that we are subject to certain laws related to how the money that the pool has is invested. So my recollection from when I served as a lawyer at TML is that a statute called the Public Funds Investment Act applies and pretty much limits, if you will, the risk level of the investments that the pool can make. So tell us a little bit about that.
A great question. And many members know that I participate in the training for the Public Funds Investment Act that TML puts on twice, 3 times a year. The Public Funds Investment Act is designed for cities, and its main goal is to keep money protected. Very conservative investments, government-backed securities, keeping your money short. Don't invest in long-term securities as much. Now, the risk pool is a little bit different than a city because we have long-term obligations. So even within the Public Funds Investment Act, Scott, we invest in government mortgage-backed securities, still very secure investments. What you mentioned, Scott, is back in 2019, the law changed for presumption for firefighters and the type of cancers that qualify under the presumption law. And at that same time, they provided the pool some flexibility to go ahead and look at those long-term obligations rather than keeping it in government securities, which have been yielding under 1% for a long time. We were able to diversify the portfolio. It was a big move for our board to bring in stocks and bring in corporate bonds. But remember, that's only for the workers' comp fund and only for the losses related to the long-term liabilities.
Right. So to be clear, we have had another podcast or another video where we've spoken to Phil English with our workers' comp department. And Phil talked a little bit about how that presumption statute works. So if you want to go back and listen to that to get a little bit more detail, you can do that. But basically, the legislature said the risk pool through workers' compensation is going to have to cover more types of diseases that are presumed to be gotten at work by a first responder. But when they did that, because those pay out over the long term, they allowed the pool a little bit more leeway in how they invested the funds that will ultimately pay that.
Exactly, Scott.
To wrap up, let me just ask you this. How do you feel about the state of the pool's finances generally?
You know, I love when the president goes up there and gives the State of the Union, because when the first thing he says is, ladies and gentlemen, the State of the Union is strong. And that's where I got that, Scott. But everyone knows that when I talk to our board or to anyone in the public, and I'm going to talk to you now, the financial state of the risk pool is stable and solid.
That's awesome. Well, I'm thrilled that we've got somebody who's got this much experience doing this and has been so dedicated to the pool for 3 decades. So thank you very much for joining me today.
Thank you so much.
Thanks, Tito. All right, I'm here today with Lindsey Fields, who's the Deputy Executive Director and Chief Operating Officer of the TML Risk Pool. And we're going to talk about a topic today that many of you probably have never even heard of, but it's one of the most important things that the pool does, and that is reinsurance. So welcome, Lindsey.
Hi, thank you, Scott.
We're so excited to have you today, and you're really the pool expert on reinsurance. I know you've been going to a lot of meetings over the past weeks with our reinsurers and talking to them about the market. Tell us a little bit about, just very basically, for someone like me can understand what reinsurance is and why we need it. We have reinsurance for workers' compensation and other funds, but the most important thing that we're dealing with reinsurance this year is property, right? And the reasons for that you may have heard in other prior videos that we've done. The Winter Storm Uri is the huge one, inflation, and there's other issues. So tell us a little bit about how those interplay with the reinsurance.
Right, so our property reinsurance placement, it's been a challenge over the last couple of years because it's such a hard market, and we keep saying that. But I think this year's reinsurance placement for our property program was the most challenging because we're still in a hard market, but what's also been added are the inflation, the increased cost in construction, as well as just this uncertain time within the reinsurance market of how they want to handle inflation, as well as how they want to handle the climate change that they see happening, the more severe and frequent storms we're seeing happening globally. When we go meet with our reinsurance markets, they're not just dealing with losses in Texas, not even just the United States. They're dealing with losses that they cover globally. And so it was really challenging in that there wasn't a lot of certainty about where the rate should be now, as well as where rates should be in future years. So that was probably the one of the biggest challenges we faced with the market. But the second challenge we've had is, the pool's loss ratio with the property fund for these losses is not in a good position. And of course, last year's winter storm was a huge occurrence for the pool. And so we were actually, as we went into the placement last year, the winter storm had just occurred. But this year, we now have a better idea of where that occurrence sits. And of course, it is a pretty significant loss for the pool that our reinsurers just weren't expecting. So those were the biggest challenge with placing our property reinsurance this year.
And so tell us about how the reinsurance actually works, right? So the pool has money and it has reserve funds and member equity, that we call it. Tell us how that process actually would work. If there was an event that was so massive that the pool's backup couldn't cover it, then we move to reinsurance, right?
Sure. So we place reinsurance in layers of up to $300 million in an occurrence. And the pool retains up to $10 million of any major catastrophe. And then after that $10 million, there's different layers for insurance that these reinsurance markets come in onto our program, and they actually cover those losses for us. It's kind of insurance for insurance.
Yeah, that's right. That's the term I was looking for. Insurance for insurance companies. And those insurance companies have insurance companies too, right?
Exactly.
I guess it must stop at some point. Right?
Exactly.
Yeah. So tell us a little bit about the drivers more in detail of the reinsurance market that we're dealing with now.
The drivers are I know we're going to keep saying this, but inflation this year. So inflation comes into play in that the reinsurers have to, they have an inflation factor that they put against the pool's data that we submit for the reinsurance placement. And they apply this inflation factor of where they think the pool's, the cost of claims will be. And that was significantly higher this year than prior due to the state of construction costs, due to the state of inflation across the United States and globally as well.
And so how do they determine, they being the reinsurers, how do they determine whether or not they want to write the pool, or whether or not we're a good risk for them? How do they make those determinations?
The pool submits, it's very similar to how a member would submit a renewal packet or a quote. The pool submits our book of business, we submit our loss history, and we basically have to go through a renewal each year. We're lucky in that we have quite a few reinsurance markets that have been a partner with the pool. They understand our pool, our members' partnership, the pool's partnership in general, and we like to say that they're partnering with us as well. And so a lot of them, we've been very, lucky in that a lot of the reinsurer markets that we've had on our program have been on the program for 10, 20 years. And so they're looking at our program as, okay, what do we want to renew it at this year? What layers do we want to stay at, and what premium or we call it premium in the reinsurance world, what premium they would want to charge for that layer.
And it seemed to me when I had some exposure to the meetings that you had with the reinsurers, a lot of what happens is based upon trust, and it's based upon their trust that you and others at the pool know what we're doing and know how to manage the organization, and that makes it possible for them to write those coverages.
Exactly. Right? You're right. Exactly right.
So some of our members will be seeing rate increases, and we've talked about the drivers of that. Winter Storm Uri, the pandemic is always in the background, inflation, equipment costs, materials costs, all those drivers. How do those play into the reinsurance market?
Well, the reinsurance market, it is insurance. So they're seeing the same rating pressures that we see as a pool and as our members are seeing, and even we all are, I think, in our personal lives, right? So the reinsurance, what's a big driver of course, we saw the rate increase with our reinsurance placement this year, and a big driver of that was inflation. It was being able to have the premiums set at a rate that we could get new markets in where we needed the capacity, as well as keep the current markets that have been a partner with the pool and have helped us with these really large property occurrences we've had over the last 5 or 6 years, such as Harvey and the winter storm Uri that happened. Those reinsurers markets, they take hits on those losses as well. So they have to incorporate that into their rates.
Thanks for being here, Lindsey.
Thank you, Scott.
In our final episode of the series, I'll interview Jeff Thompson, the pool's executive director. So stay tuned.
To review written materials associated with this episode or to ask Scott a question, please visit www.tmlirp.org and click on the STP podcast button. For specifics about your entity's coverages or rates, please contact your member services manager.